Imagine walking an ultra-exclusive enclave of pristine architectural masterpieces, the kind of neighborhood where the hedges are perfectly manicured and the driveway gates require a security clearance. Now imagine those exact same properties with foreclosure notices slapped onto their glass facades, moving trucks blocking the driveways, and desperate owners quietly fleeing under the cover of night. This is not a hypothetical scenario. It is the absolute bloodbath ripping through the American luxury real estate market right now in 2026. Properties that were deemed completely untouchable just 36 months ago are currently bleeding up to 65% of their value, leaving high net worth buyers and supposedly sophisticated investors trapped in a brutal financial nightmare. What we are witnessing is the ultimate collective hangover from a decade of cheap money and pandemic-fueled mass hysteria. Everyone forgot the basic laws of economic gravity. Buyers assumed that a spreadsheet could outsmart reality, and now the reckoning has arrived. The truly terrifying part of this synchronized meltdown isn't just that prices are falling. It's that the rules of the game have been completely rewritten. The root cause of this wealth destruction is no longer just high interest rates. The market is being choked to death by a quiet systemic convergence of crippling insurance premiums, massive tech sector layoffs, predatory local tax policies, and a sudden, violent shift in municipal stability. There is a delicious dark irony in watching builders desperately slash prices by millions of dollars just to break even on speculative megamansions that nobody wants, while affluent sellers cling to their peak pandemic delusions. But nothing compares to the absolute catastrophe waiting at the very end of our geographic autopsy. One specific coastal haven where multi-million-dollar estates are practically being given away because of a bizarre local zoning crisis that nobody saw coming, completely obliterating generational wealth overnight. Understanding the hidden mechanics behind this unprecedented meltdown is the only way to avoid catching a falling knife. If you want to protect your capital and find out where the actual flaw is, you have to look closely at the localized disasters currently playing out across the country. Number 10. Austin, Texas. The tech utopia that promised endless sunshine, a cultural renaissance, and zero state income taxes has officially hit a brutal psychological brick wall. Just a few years ago, every remote software engineer and venture capitalist fleeing the West Coast was throwing absurd amounts of cash at any Austin property with a decent backyard and a pool. It was a gold rush built on the assumption that the migration would never end. Today, those exact same buyers are running for the exits, and the luxury tier is absorbing the brunt of the damage. Recent data from Redfin reveals a staggering truth. High-end inventory in the Texas capital has spiked by an unbelievable 315% since the peak of the boom. Sellers who greedily bought in at $2 million are now quietly dropping their listing prices by $500,000 just to convince a single prospective buyer to show up for a viewing. It is frankly hilarious to watch these homeowners refuse to accept that the era of free money is completely dead. According to the Texas Real Estate Research Center, homes priced over $1.5 million are now sitting frozen on the market for an average of 210 days, a catastrophic jump from the 15-day average we saw during the frenzied peak of 2022. The core issue driving this localized crash is a brutal property tax reality. Local appraisal district data indicates that property tax bills for these premium estates have surged by 40% over a mere 3-year period, effectively wiping out every single dollar of perceived savings from the lack of estate income tax. Combine that with Austin Chamber of Commerce reports highlighting a 14% drop in high-paying engineering jobs over the last 12 months, and the pool of qualified buyers has completely evaporated. Imagine trying to keep up with an $8,000 monthly mortgage payment when your company's stock options just lost half their value. The critical lesson here is clear. Never blindly trust a geographic boom without calculating the long-term carrying costs under a worst-case scenario. Number 9. Boise, Idaho. The ultimate pandemic escape destination has officially transformed into a mountain town ghost town for luxury real estate. The affluent urbanites who fled crowded coastal cities to buy massive rustic log cabin mansions are now experiencing an acute case of buyer's remorse, and the local statistics are terrifying. According to the Intermountain Multiple Listing Service, the median price for the top 10% of properties has plummeted by 32% over the last 18 months. But the real bleeding is happening at the absolute apex of the market. Homes appraised at over $2 million are experiencing massive price cuts of up to 50% just to attract local interest. Zillow recently published a highly concerning report showing that 68% of luxury listings in Boise have undergone at least 3 major price reductions before finally securing a pending offer. It is tough not to feel a tiny bit of cynical sympathy for the locals who were completely priced out of their own hometowns, only to now watch out-of-state remote workers desperately try to dump their oversized rural palaces. A deep dive by the Idaho Department of Labor reveals that local wage growth has stagnated completely at a mere 1.2% annually, making it mathematically impossible for the domestic workforce to absorb these high-end assets. Meanwhile, national mortgage data indicates that 45% of these premium purchases were financed with adjustable-rate mortgages that have now reset to brutal 9% rates. Imagine the sheer panic of seeing your monthly housing expense double while your employer simultaneously issues a strict return-to-office mandate 2,000 miles away. Real estate is fiercely local, and relying purely on out-of-town salaries to sustain inflated property values is a disastrous financial gamble that always ends in bitter tears for the late adopters. Number 8. Seattle, Washington. The corporate macroeconomic climate in the Pacific Northwest has shifted from unprecedented expansion to aggressive consolidation, directly destabilizing the high-end residential sector. According to the Northwest Multiple Listing Service, transaction volume for residential properties priced above $2.5 million collapsed by 58% in the 12-month period ending in early 2026. This contraction tracks a broader regional labor adjustment. Data published by the Washington State Employment Security Department confirms that regional technology conglomerates have eliminated over 42,000 high-income positions since the peak of the post-pandemic cycle. The contraction has severely impacted inventory metrics in premium waterfront enclaves across King County. A comprehensive regional market analysis conducted by Redfin indicates that the average time on market for luxury estates has expanded to 185 days. Concurrently, regional legislative changes have altered the tax landscape for high-net-worth residents. Figures released by the Washington State Department of Revenue show a 25% decline in the registration of ultra-high bracket tax filings following the implementation of the state capital gains tax framework. This legislative shift has decreased the density of local luxury buyers. Furthermore, regional safety metrics have compounded the downward pressure on property values. Municipal data cited by the Seattle Police Department shows that property crimes within historically affluent zip codes increased by 33% over a 24-month period, elevating security overhead costs for remaining property owners. This domestic instability coincides with a reduction in liquid corporate compensation. A University of Washington economic study reported a 41% reduction in total restricted stocks unit payouts across regional technology firms, limiting the cash capital available for high-end real estate down payments. Number 7. Denver, Colorado. The metropolitan real estate framework near the Rocky Mountain foothills is experiencing a severe correction driven by structural changes in the short-term rental sector. Over a 5-year period, private institutional capital and speculative investors acquired premium properties, utilizing short-term hospitality metrics to leverage significant mortgage debts. This operational model has broken down. Data compiled by AirDNA reveals that the average daily rate for luxury short-term rental properties in the Denver-Aurora-Lakewood metropolitan statistical area fell by 42% over 24 months due to severe market oversaturation and strict municipal zoning ordinances. The reduction in cash flow has triggered an influx of distressed liquidations. The Colorado Association of Realtors reported that the total inventory of active listings priced above $1.8 million surged by 215% year-over-year. Financial analysis by the Denver Business Journal indicates that approximately 40% of these investor-owned upscale properties possess negative equity, relative to their current appraised market valuations. This structural deficit is further aggravated by unprecedented escalations in fixed carrying costs. The Colorado Division of Insurance documented an average premium increase of 55% for residential assets situated within wildland-urban interface zones, driven by updated wildfire risk modeling. Concurrently, national mortgage origination data indicates that 52% of these luxury acquisitions were executed using interest-only debt instruments that have recently transitioned into full principal amortization schedules, compounding monthly debt obligations. Number 6. Phoenix, Arizona. The luxury residential tier within Maricopa County is undergoing a rapid devaluation following the strategic retreat of corporate institutional buyers. Institutional asset managers and high-volume real estate investment trusts previously inflated values through programmatic block purchasing. Records from the Maricopa County Assessor show that corporate liquidations returned a staggering 4,000 premium homes to the open market in a single quarterly period. Consequently, the CoreLogic Home Price Index shows that top-tier residential values in the Phoenix metropolitan area have declined by 48% from their cyclical peak. The downturn has been accelerated by critical regulatory interventions concerning environmental resources. The Arizona Department of Water Resources issued comprehensive restrictions on new groundwater pumping allocations within peripheral suburban boundaries, instantly depressing appraised values for unbuilt or partially completed luxury developments. Zillow transaction data confirms that high-end properties relying entirely on private well systems experienced a 61% reduction in buyer inquiries compared to assets connected to verified municipal infrastructure. This infrastructural risk is joined by rising operating costs. Local utility reports indicate that summer electrical cooling expenses for properties exceeding 6,000 square feet rose by 38% due to regional grid adjustments and extreme seasonal temperatures, further diminishing the financial viability of these holdings. Number 5. Las Vegas, Nevada. The luxury housing sector in Clark County is experiencing a severe contraction as macroeconomic shifts impact speculative property investments. Following an influx of out-of-state buyers utilizing remote work flexibility, the median transaction price for luxury residential real estate in the Las Vegas Valley fell by 52% from its peak. According to the Las Vegas Realtors Association, the localized flipping market has largely ceased functioning. Analytical data published by Atom Data Solutions shows that average gross flipping profits within the premium real estate sector dropped by 75%, resulting in an accumulation of unfinished luxury renovation projects across the market. This structural slowdown aligns with broader economic indicators in the hospitality sector. The Nevada Gaming Control Board reported a 6% deceleration in total gaming revenue growth, a metric that historically correlates with local executive workforce reductions and subsequent defaults in non-primary residential mortgages. Zillow market trackers indicate that luxury properties currently require an average of 4 consecutive price reductions before executing a contract or being removed from active listing sheets. Fixed overhead costs have similarly trended upward. Regional energy data shows that commercial and residential electrical tariffs for high square foot properties increased by 42% within a 12-month timeframe, directly expanding the carrying costs for over-leveraged property holders. Number 4. Miami, Florida. The structural mechanics of the South Florida luxury condominium sector are experiencing an unprecedented regulatory and financial unwinding. Following safety legislation enacted after the 2021 Champlain Towers South collapse in Surfside, the state implemented Senate Bill 4D and subsequent statutory updates that completely banned long-standing reserve funding waivers. As of the regulatory deadlines, condo associations are legally mandated to execute comprehensive structural integrity reserve studies and fully fund all deferred maintenance liabilities for core structural components. This sudden regulatory pivot has ended decades of deferred capital expenditures. According to records from the Florida Department of Business and Professional Regulation, 56% of condominium associations in Miami-Dade County entered the year in technical non-compliance with these mandatory reserve thresholds. To achieve statutory compliance, boards have been forced to levy massive special assessments directly against unit owners. Data indicates that average special assessments across older waterfront luxury buildings range between $50,000 and $400,000 per individual unit. This sudden capital call has triggered a severe liquidity crisis among property owners. Analytical data released by Redfin shows that inventory for high-end condominiums across major coastal zip codes has expanded by 420%. This volume surge has caused transaction prices in vulnerable waterfront corridors to fall by up to 55% from their previous cyclical highs. Furthermore, structural financing has largely evaporated for these properties. National mortgage clearinghouses, operating under revised strict risk guidelines from major underwriters, have classified a significant portion of Miami's older high-rise inventory as unbankable, effectively removing conventional mortgage financing from the transaction ecosystem and forcing remaining transactions to rely entirely on discounted cash buyers. This structural disruption is compounded by a simultaneous crisis in the secondary insurance markets. The Florida Office of Insurance Regulation documented a 180% increase in average coastal property insurance premiums over a 24-month period. While multiple national insurance carriers have formally filed to restrict exposure or entirely exit specific coastal zip codes, leaving high-value assets exposed to severe uninsurable risk profiles. WMillionLuxury.com, Show 1 No. 3, Los Angeles, California. The luxury residential market within the municipality of Los Angeles is undergoing an institutional asset devaluation driven by structural tax policies, localized industry contractions, and escalating municipal overhead. The primary catalyst for this transaction freeze is Measure EULA, the documentary transfer tax enacted by local voters. This structural policy functions as a gross receipts tax rather than a marginal bracketed tax, imposing a flat 4% levy on all transactions exceeding $5.4 million and a 5% levy on transactions exceeding $10.9 million, irrespective of whether the asset is sold at a capital loss. Independent research published by the UCLA Lewis Center confirms that the implementation of Measure EULA led to an immediate 55% reduction in the baseline likelihood of high-value properties executing a successful sale. Transaction volume for single-family estates valued above $5 million collapsed by approximately 68%, transforming the upper tier of the West Side luxury market into a highly illiquid asset class. This legislative friction coincided with systemic disruptions within the regional employment base. The California Employment Development Department documented a 22% contraction in high-bracket entertainment sector compensation over a 24-month evaluation period, a direct consequence of prolonged labor disputes and a structural reduction in domestic media production budgets. Consequently, the volume of luxury residential properties sitting on the market for greater than 300 days spiked by 84% across prominent enclaves such as Bel Air and Beverly Crest. At the same time, localized risk metrics have elevated the ongoing carrying costs for these estates. Municipal data published by the Los Angeles Police Department showed a 29% increase in targeted residential burglaries within historically affluent reporting districts, driving significant secondary investments in private security infrastructure and specialized structural fortification by remaining estate owners. WWRayleonRealty.com No. 2, Naples, Florida. The ultra-luxury coastal real estate market in South Florida is experiencing a violent 60% valuation adjustment in its beachfront tier, caused by an absolute breakdown in the actuarial mechanics of the private insurance market. Following a sequence of major meteorological events, the financial underwriting models for coastal exposures were fundamentally altered. The Florida Office of Insurance Regulation confirmed that annual policy premiums for multi-million-dollar beachfront properties in Collier County escalated by an average of 240% within a 36-month period. This escalation has fundamentally detached fixed carrying costs from traditional asset valuation models. Transaction metrics tracked by Redfin reveal a 380% expansion in luxury single-family home inventory, as a dense concentration of property owners attempts to liquidate coastal holdings prior to subsequent seasonal weather windows. This market saturation has revealed deep structural vulnerabilities in properties situated below newly established Federal Emergency Management Agency base flood elevations. Local municipal appraisal records confirm that properties failing to meet modern structural elevation thresholds face automatic valuation discounts of up to 55% from cash buyers who are willing to absorb the uninsurable carrying risk. The transaction pipeline has experienced widespread structural failures. Zillow market intelligence reports indicate that 42% of executed contracts for luxury homes in the Naples coastal zone collapsed during the escrow phase, specifically due to the inability of the buyer to secure formal windstorm or flood insurance underwriting from any solvent, domestic or international carrier. This operational gridlock is further aggravated by a 45% increase in local municipal infrastructure assessments, levied directly on property owners to fund the structural reconstruction of degraded regional seawalls